Alrighty, everybody. Just getting everything ready here. I think, not sure exactly when Zoom always follows through on the Facebook Live. There we go. Okay, welcome back for sort of another episode here on the Southern California housing market. Once again, for those of you joining us, we run our stats based on Los Angeles and Orange counties. I can probably give you an opinion on other areas, but it's not those areas I'm not an expert in. So when we run our stats, we talk about things, we are talking about them for Los Angeles and Orange counties. So first off, before we get into the stats, I want to talk about, kind of what's going on, because I think this is something that's on everybody's mind. And, this is not clickbait. I think the biggest pressing question that I get on the streets from people when they come up to me, or friends and family and people I run into, is they ask me, is this recent round of reclosures, is this kind of like just sort of sucking the wind, out of our sales, right? Like what's going on sort of in our market, and, is that having sort of a material effect? And if you will remember from last week, we definitely did see some softening, but it's also important to remember last week was 4th of July, was the week, a holiday week. And, those results can be unpredictable a lot of times, especially for a holiday like 4th of July, where people tend to either go out of town or they tend to just go and do something other than want to buy houses. And let's be honest, a lot of realtors are the ones who are unavailable, and that's why the deals tend to not happen so much that weekend. Anyhow, I think it's kind of interesting this week because we have really a much better baseline, and I think we also have some very interesting comparisons this week between right now and this exact time last year. So kind of without any further delays here, I'm going to kind of jump into some of our stats. There we go. And there we go. So, what we're looking at again is probably the biggest change, and maybe I'm kind of not making you wait longer for this, but something that I want to point out here that I think is really important is this is our supply side of the equation. I think everybody is obsessed with this notion, right? Are all the buyers that we are seeing out there every weekend, is this just pent up demand, or is this actually a strong market? I think that is not the most important thing to be talking about. I think supply is the most important thing to be talking about. And this week, we finally see evidence of something that I've personally been predicting. So if you notice this little green bar here, that's a jump. We've had pretty steady new listings coming on the market. And then all of a sudden this past week, boy, it's like everybody decided to put their house on the market at once. I mean, not really, but it's definitely kind of a move. And I predicted this, and the reason why is because we tend to notice an interesting trend in our market, and that is that people tend to be behind the curve. So for example, if your neighbor puts their house up for sale and the market is super hot, they're gonna have a hot market. They're going to get an offer on that house. They're going to go into escrow, and 30 days later, they're going to close. And then your neighbor is going to see what that house closed at and think, wow, that's $20,000 more than I thought they would get for that house. Maybe now's a good time to put my house on the market. So we kind of see this delay effect from a hot market where the sellers tend to come later in droves because they see the evidence of what the houses are selling for. They're hearing it on the streets. And we're seeing this in both price categories, right? Under $1 million, as well as sort of our $1 million to $2 million range too. Maybe a little bit less there, but we're definitely still seeing it. And one of the things that I think is kind of funny, and this has been true for real years in real estate, right? This isn't any COVID-19 special thing that we're seeing in the market. People in general, the public, tend to be behind 30 to 45 days of reality in the marketplace. So by the time the newspaper writes an article about the hot real estate market, they're talking about the market 30 to 45 days ago. And it might still very well be hot, but it's kind of always interesting because we just see these sort of latent effects, right? And when people are deciding to buy a house, that's a much easier decision to make quickly, especially for first-time home buyers, right? It's like, oh, my lease is coming up. Yes, I want to buy a house. I'm going to go out next weekend and maybe I'll find a house. Selling a house is a little bit different, right? There's a lot of planning that has to take place to make a move occur. There's a lot of preparation sometimes at the house. So we see that in general, sellers tend to lag behind buyers in terms of responding to market information. So, I've been kind of predicting there was going to sort of be this point where the inventory finally starts going up, and it looks like we are reaching that point now. But what's interesting about that is I will tell you that has almost nothing to do with the reclosures. So if we go in here and we look compared to last year, we're still behind, right? Like, so even though our listings jumped up a bit, we are still behind the same week last year. And if you watch these every week, you might notice this is opposite last week. I think last week or last year's July 4th numbers were affected much more than this year's. But now that we're in a more normal week, guess what? 2019 was still a better year in terms of the number of listings coming on the market. We're down by quite a bit less than we have been down, but we're still really not caught up to where we were pacing last year. And frankly, last year was not that great. So if we're looking at if listings are the supply side, right, what is the demand side of the equation? And you'll notice we did have a little bit of a demand hiccup last week. And, the question on everybody's mind is this the beginning of the end, or is this more of a hiccup, right? And, we have rebounded a little bit. So guess what? These new pending transactions, these new contracts that were negotiated, we have rebounded a little bit. Still not where we were for the past month, but way more than the time periods before that. So, and we see kind of a similar trend, a little bit of a rebound over here in our $1 to $2 million market as well. If you were to ask me what I think is happening, and please understand this is just sort of me fitting a theory to the data. I think that while everyone has been focused on this question, I'm going to bounce out of here for a second. I think everyone has been focused on this question. Is this sort of crazy market we're seeing, is it the result of pent-up demand for buyers, or, this is really a good time to buy, interest rates are low and buyers are just out there in droves and this is sustainable? And I think that's really a mistake to think that our current market conditions have to be one or the other. I think there are elements of both. So we're seeing things maybe fall back a little bit in terms of the number of escrows, but I don't think that necessarily means that all this demand we've been seeing has just been pent-up demand. I think a lot of what's happening this year is that things are just happening delayed. It's almost like we had a period of 2 months that just didn't happen. Nobody did anything. So right now, if you were to ask me the last month, what has our market been like? It felt like a spring market, not like a summer market. And now it looks like we're starting to finally transition to that summer market, but we're about a month or a month and a half late compared to where we normally are. And maybe next week I'll be able to get some charts to kind of show you median prices so you can see what times of year are really sort of the hot times of year for the market for us typically here in Southern California. So jumping back in here and taking a look again at our demand, we can again run this and compare this and benchmark versus last year. And what's interesting is this just shows you a couple things, right? We are higher this week in 2020 versus where we were in 2019. We're the opposite of where we were versus listings. And really, there's a couple of conclusions you can draw from that. The first conclusion is this is actually still a really good market in terms of demand. We still have a lot of buyers out there, even given kind of a historical perspective. The second thing to take note on this is that, 2019 wasn't really that great of a year around this time. And I think we have a lot of room for, if this is a bump in demand that really was just pent up demand and then we're just going to sort of run out of it and catch up, we still have a long way, or a decent amount to fall, and we're still ahead of where we were last year in terms of kind of the number of buyers that are out there. I'm also wondering too, with the increase in inventory this week, is that going to translate into an increase in transactions next week, right? Because one of the things that we notice is these things aren't aligned perfectly, right? If you're running out of houses to sell, let me go off here. If you are running out of houses to sell, your pending numbers will be low. Even though you have buyers out there in droves, the number of sort of transactions taking place, the number of contracts coming together, it will be low. you're sort of in this inventory constrained situation. And I think there's some arguments to make that that is where we have been for the past 30 days. Now, this week, we've got a whole bunch of new houses on the market, but remember, it takes time for these houses to get absorbed. Contracts don't happen instantly. So this week's new listings could end up being next week's contract. So it'll be very interesting to see if we have a bump in contracts next week. If we do, it means that the buyers are still out there in droves. They're just not finding enough houses to buy, and that, you know, inventory will lead to more transactions taking place. So kind of interesting. I think we'll have to wait until next week to see whether that is what's happening, but I have a feeling that's kind of what's going on. So if we look at our absorption rate, and remember, this is sort of our measurement each week of supply versus demand. And, you know, if you look, both of our absorption rates at both price categories took a bit of a fall. That's sort of a mathematical requirement. If new listings go up, but the pendings don't go up by the same amount, that's kind of what happens. We're still at an incredibly healthy level. And understand, we had some lower months on absorption there, especially towards the beginning of the stay-at-home orders and things like that. But this latest week, it's dropped. But I will tell you, 80% in the under $1 million category is still a pretty healthy number. I wouldn't say this is a reason to be alarmed. And like I mentioned, the real tale of what's going on is we told by our pendings next week. Did they jump to take advantage of all the new listings on the market? Almost the very same thing in our $1 to $2 million category right over here. You know, and now we can also take a look, right, at our absorption rates. You know, if we're looking at the first week of the month, right, for 2019, you know, we can see that generally, you know, generally we do have sort of in the 70s as kind of a normal market, I guess you could call it. And anytime you're above that, it's sort of a hot buyer's market. Anytime below, or a hot seller's market, below that is sort of a buyer's market. The first week in July apparently was a pretty good week last year. And I think that was mainly because there was almost no new listings that came on during that first week in July last year, but there was still a decent number of sales. So we'll see, you know, this might just be an artifact of measuring that first week of the month and having it being a holiday week, which is a little funky. So this is kind of something fun that I've been doing. And one of the things that we're talking about, and you might have heard other realtors and other people in the real estate industry mentioning this, is that while the market is hot, the number of transactions, which is different than sort of the dollar amount, the number of transactions has been reduced. We've been kind of playing this game of catch up, right? Like we've just had fewer transactions taking place. So if we look at this chart here, if I bring this up for you, we can kind of go through and follow what's happened this year and compare it 2019 versus 2020 and sort of see what's been happening. And again, this is based on sort of our first week of the month sale. So that's the reason why we have this graph this week, but we haven't had it in other weeks. So, you know, January, boy, it looked like 2020 was going to be good. February, super strong. March, what happened in March? We had a stay-at-home order. And then April, May, boy, those sales certainly kind of fell off a cliff in terms of the number of sales. But look what's happened. We caught up a little bit in June, and now look where we are in July. Whereas in 2019, things were starting to go a little soft on us. Things are still trending upward in 2020. And I'm telling you, that's really just sort of a, you know, this graph is basically 30 days old. And let me explain what I mean by that. I've said this a number of times before. You have to be very careful. Sold data is old data. And, you know, a lot of people don't really like to bear that in mind. So you have to think of it. This is a snapshot of what was happening 30 or 45 days ago. So the sales that have occurred in July, those were really contracts, right, that people negotiated in June. So, you know, this data is 1 month delayed. That also means that last year in 2019, the market really didn't cool off in July. It cooled off in June. And I think that lends a lot more credence, right, to this theory that our spring is just very late in arriving this year, market-wise. I think that's probably the biggest effect of COVID-19 is I think it is just very much delayed things. So if we go on to our next chart here, if we look at our change versus 2019, again, gosh, it was shaping up like 2020 was going to be a great year, hitting over 100%, and then things just went. But they started rebounding, and now, a rebound is actually almost exactly to where we would expect to be. So, I think the purpose of a graph like this is, are we on track? I think the answer is yes. And let's take a look at prices, because I think this is sort of a statistic that I am a huge, huge fan of. It is not perfect for a couple of reasons, but I like it a lot better than sold data. And the reason why I like it better than sold data is because I can tell you what happened in the past 7 days in the market with this graph. And if you look, guess where our pricing is? It jumped right around $2,000 to $3,000. So basically it moved, 0.4%. That's still a very strong week-to-week performance. 0.4% is quite a bit. I don't think this pace of prices increases will exist throughout the year. I do think we have a lot of room on prices to grow. I've got our affordability chart at the end, but I just don't see this being like a 12%, 15% appreciation year. I think what we're doing is we're getting a spring that has been very long delayed, and we're seeing kind of a pretty big run up in prices, and then we're going to plateau at some point for the summer. So that's sort of my official prediction. And you'll see, we haven't jumped. We've had some big jumps in here. If you look, there were a couple weeks where things just went gangbusters. And of course, if you look compared to our low, right, our average pending list price, this means what the list price was of the houses that are in escrow. I mean, we are a whopping almost $40,000 higher than our low point back in April 6th. And I think people just don't realize how remarkable that is in a 3-month period of time to have like a 7%, so was that 40 grand? Yeah, 6-7% increase in pricing in a 3-month period. I mean, that's on pace for like a 25% year. I just don't see us having a 25% year. So if you're looking to buy a house, that's good news. It means houses won't get a quarter more expensive. If you have a seller, if you're a seller, I think this is still good news. It just might not be as, and if you're looking to buy another house, right? If you're selling and buying, this is still pretty good news for you. If we look at our numbers in this sort of 1 to 2 million range, and remember, we sort of changed our methodology here around 519. We were 1 million plus, and then I decided to kind of put a cap on it because we were getting sort of wild data variations, and I didn't like it. If you look here, we're actually seeing this market's a little bit flatter price-wise. We haven't really moved a huge amount, since this, especially as a percentage of these home prices. So I think that market is a bit more stable. We also have a much smaller sample size, and that could throw around the numbers a little bit more, but I'm not seeing that upward trend that's so clear and defined as it is in our $1 to $2 million price categories. If we go back to our days on market, this sort of lends a little bit of credence to our theory that our pendings might be supply constrained. Normally if a bunch of listings hit the market and there aren't as many buyers out there, days on market tends to go up. In this case, we dropped another 2 days. So we are now at 30 days on market. And I'm going to say something really quick. This is going to be a little bit nerdy for people, but I promise this is something that's kind of cool. So if you think that if you see 30 days on market as the average, the logical conclusion somebody would draw is that means on average, houses sit on the market for 30 days before somebody buys them. That is wrong. And I'm going to tell you why that is not logical. So our MLS system has a couple statuses when you accept an offer in it. So in fact, I just did this today. We had a listing of ours, beautiful condo in Anaheim Hills. It went into escrow after only 6 days. When I take an offer, when we accept an offer, I can change it to one of two things in the MLS. I can change it to pending. And when I change it to pending, that days on market counter stops on that listing, meaning it is frozen at 6 days now that I've made that change. Or I can put it into something called active under contract. And active under contract is sort of like accepting backup offers. There's a lot of variations around the country for this and in different MLS systems. But active under contract, that counter still continues to move up. So what does that mean? It means that this figure of 30 days on average is a little bit skewed, and it's skewed bigger than it actually is. I would say that if I ran this stat, in fact, I should probably do this. This would be fun. If I ran this stat just on the pendings, not on the active under contracts together, right? If I didn't look at all the houses in escrow, if I just looked at the ones that are pending status where the days on market has stopped, I bet we will find that that number is more like 15 to 20 days. And that, I mean, that's pretty crazy. That means on average, we have like 2 weeks of inventory in our marketplace. I mean, that's just pretty interesting and pretty crazy. So let's continue onward. Sorry for the nerd out for a minute, but yeah. So don't take this at face value. It's not exactly accurate. Okay, this is a little statistic that I ran because I felt like this is something that's always kind of interesting to me. I don't think I've explained this before, but I think the list to close ratio is sort of a great measurement at how different are the expectations of buyers and sellers. So hear me out on this. I'm going to use a real life example. If I put my house up for sale for $500,000 and it gets bid to $525,000, that means as the seller, my expectation of the market was different than the buyers. Buyers are willing to pay $525. I, on the other hand, thought that $500 was a fair price. Now, some people put their house up low to try to get multiple bids. Other people put it up overpriced just to see if it happens. I get that. I think that kind of all evens out in the wash. So if we look over time here, at the bottom of this thing, our list to close ratio was, about 99%. And remember, if these things are properties that closed the week of May 26th, that means that they were contracts from April. And then we've watched as this is sped up, sort of indicating that there's this lag in information, right? Like buyers seem to know what the market is doing a lot faster than sellers know what the market is doing. And then we sort of, but what's funny is look where we are approaching. We're approaching 100%. That's a big deal. And then if we take another statistics, I said, well, why don't we look just at the properties last week that both went into escrow and closed? So these are ones where the contract was negotiated in the last week too. Say maybe a cash buy or somebody like that. And we are actually over 100%. So I think we are in a market right now where the deals we are negotiating today are at or above list price on average, which is just sort of nuts to me, right? Like that is sort of a hyper competitive market when your average is over 100% for a list to close ratio. So this is one we're going to keep tracking this over time, because it means if our market changes trajectory and it heads downward, we can sort of see that effect happening very quickly if we keep track of this. So this is kind of a useful one to look at. And then finally, before I jump into this, I really liked including this affordability graph, because I think sort of from an intuitive standpoint, if I were to walk around the street and I tell people homes are less expensive today than they were 2 years ago, I will end up in a mental institution. People will have me committed because they'll think that I'm completely wrong about that. And I think this is actually really when statistics are the most valuable, is when they teach you something that your intuition would never figure out on its own. And so let me jump to the graph, and I'll kind of give you a little bit of behind the scenes data on it too, because of the numbers that make this up. So if you look over time, and again, I'll give people a brief explanation. We're looking at June of 2018 as a baseline, right? We're calling that our 100% factor baseline. And this is the payment on a median priced home. So if we look, there's kind of a nice little rhythm and a pattern to this, right? It jumps up, then it goes down, then it goes up, then it starts going down. But now it's starting to go back up. And in fact, we jumped quite a bit. We're almost to 92% on this graph. Now, we still have a long way to go, right? And I mentioned this before, not only is 100%, that's 100% 2 years ago, right? I mean, wages, what has happened in the last 2 years? You could arguably say housing has room to grow beyond 100%. But this is interesting because mortgage rates actually went down this week. So even with mortgage interest rates going down, we noticed that our payment level went up, and that's because the median price is moving that fast. And so we did this based on Orange County homes, single family and condos together, all price ranges, to get our median home price data. And just for the record, it's 785 is our median in Orange County. And when you look at this, like what this graph tells me is that things are moving at a fairly accelerated pace right now. And this data is up to the minute. This is not based on this data is based on the homes that sold this week. So I guess what I'm saying with a graph like this is, if you're a buyer, there's definitely still room to go up. But bear in mind, this graph is starting to move. This also underscores something else. When people ask me, what am I afraid of economically? Everybody thinks that, unemployment and that all these things are sort of our big fears. And, I think it's important to watch these numbers, right? Foreclosure rates, all of these things that we're starting to see with people, delinquency rates on mortgages. This stuff is all important to watch. But for me, one of the most important things to really keep track of is to understand that a lot of the market we have, a lot of the affordability that we have is the result of low interest rates. And while it doesn't seem like there's a lot of danger of rates going up prior to the election, I think 2021, all bets are off. And I think it would be very foolish to just make an assumption that those rates will continue. Imagine, if you will, a situation where a vaccine is developed, Corona is behind us, stimulus packages are in full effect, and our economy actually goes the other direction. It starts overheating. We have no choice but to raise rates, and that will sort of immediately change this price dynamic, this affordability dynamic that we have. So anyhow, I hope you guys have enjoyed it. I think I've rambled on a little bit too long this week. If you have questions, comments, you want to know about your particular situation, we are here for you. Once again, my name is Stephen Mead. I own a brokerage called Domicile Real Estate for people who love houses. We will see you next week.